Corporate finance is like the engine of a business. It keeps things running smoothly. It's about making smart decisions with money, and this helps businesses grow and succeed. We'll cover 4 key areas. First, we'll look at capital budgeting. This is how businesses decide where to invest their money. Next, we'll explore the cost of capital. This is the cost of getting money to fund a business. Then, we'll dive into valuation methods. These help determine how much a business is worth. Finally, we'll cover risk management. This is how businesses protect themselves from potential financial losses. Imagine you have some extra money. Wouldn't you want to invest it wisely? That's what businesses do through capital budgeting. Capital budgeting is the process of planning for big expenses. This could be anything from buying new equipment to expanding into new markets. The goal is to find investments that will create the most value for the company. These investments should bring in more money than they cost. It's like planting a seed that will grow into a money tree. But you need to choose the right seed and nurture it carefully. One way to evaluate an investment is to look at its payback period. This tells you how long it will take to earn back your initial investment. Let's say you're considering buying a new machine. The machine costs $10,000 and is expected to generate $2,000 in profit each year. The payback period would be 5 years. That's $10,000 investment divided by $2,000 annual profit. A shorter payback period is generally better. It means you're getting your money back faster. But be careful, this method doesn't consider the time value of money. Net present value, or NPV, is a more sophisticated way to evaluate investments. It takes into account the time value of money. Think of it this way. Money today is worth more than money in the future. You can invest money today and earn a return. NPV calculates the present value of all future cash flows from an investment. Then it subtracts the initial investment cost. If the NPV is positive, the investment is considered profitable. A negative NPV means the investment is likely to lose money. Section 5. Internal rate of return. Measuring investment efficiency. The internal rate of return, or IRR, is another important metric for evaluating investments. It is widely used in corporate finance and investment planning. It tells you the rate of return an investment is expected to yield over its lifetime. This helps investors understand the potential profitability of their investments. Think of it as the investment's own personal interest rate. Just like how a bank account earns interest, an investment earns a return. You want this rate to be higher than your cost of capital. The cost of capital is essentially the cost of funds used for financing a business. That means you're earning more than it costs you to borrow money. This is crucial for ensuring that the investment is worthwhile and profitable. To calculate IRR, you find the discount rate that makes the NPV of an investment equal to 0. NPV, or net present value, is the difference between the present value of cash inflows and outflows. This might sound complicated, but there are tools and software to help. Many financial calculators and software programs can compute IRR easily, saving you time and effort. Understanding IRR can help you make more informed investment decisions. It allows you to compare different investments and choose the one that offers the best return relative to its cost. By mastering IRR, you can enhance your investment strategy and achieve better financial outcomes. So, take the time to learn and utilize this powerful metric in your investment planning. Section 6. Cost of capital, fueling business growth. Every business needs money to operate and grow. This money comes at a cost. That cost is called the cost of capital. There are two main sources of capital: debt and equity. Debt is money borrowed from lenders. Equity is money invested by owners. The cost of debt is the interest rate paid on loans. The cost of equity is the return expected by investors. Understanding the cost of capital is crucial. It helps businesses make informed decisions about financing their operations. Section 7. Capital structure balancing debt and equity. In this section, we delve into the intricate dynamics of how businesses manage their financial resources. Capital structure refers to the mix of debt and equity used to finance a business. This mix is crucial as it influences the company's overall financial health and operational flexibility. It's about finding the right balance between the two. A well-balanced capital structure can help a company achieve its financial goals while minimizing risks. Debt can be cheaper than equity. This is primarily because debt financing often comes with lower interest rates compared to the cost of equity. This is because lenders take on less risk than investors. Lenders are typically assured of their returns through interest payments, making debt a less risky option for them. But too much debt can be risky for a business. High levels of debt increase the company's financial obligations and can lead to financial distress if not managed properly. Equity is more expensive, but it doesn't have to be repaid like debt. Equity financing involves giving up a portion of ownership in the company, which can be beneficial in the long run. It also gives investors a share of ownership in the business. This can align the interests of the investors with the company's success, fostering a collaborative growth environment. Finding the optimal capital structure is essential for maximizing a company's value. It involves a strategic assessment of the company's financial needs and growth objectives. It requires careful consideration of various factors like industry norms, business risk, and market conditions. Each of these elements plays a critical role in determining the most effective mix of debt and equity for a business. Ultimately, the goal is to create a capital structure that supports sustainable growth, minimizes financial risks, and enhances shareholder value. This delicate balance is key to a company's long-term success. Section 8. Valuation methods, determining business worth. Understanding the true value of a business is crucial for various stakeholders, including owners, investors, and potential buyers. How much is a business actually worth? That's where valuation methods come in. These methods provide a systematic approach to estimate the value of a business, ensuring that all relevant factors are considered. One common method is the discounted cash flow, or DCF, analysis. This technique is widely used because it focuses on the intrinsic value of a business. This method estimates the present value of a business's future cash flows. By projecting the future cash flows and then discounting them back to their present value, we can get a clearer picture of what the business is worth today. Remember, money today is worth more than money in the future. This principle, known as the time value of money, is fundamental to DCF analysis. DCF analysis discounts future cash flows back to their present value. The discount rate used in this calculation reflects the risk and potential return of the investment. Another method is comparable company analysis. This approach is often used when there are similar companies in the market that can serve as benchmarks. This involves comparing the target company to similar publicly traded companies. By analyzing the financial metrics of these comparable companies, we can estimate the value of the target company. Valuation is important for many reasons. It provides a basis for negotiating the sale or purchase of a business, and it helps in strategic planning and decision-making. It helps determine the price of a company in a merger or acquisition. Accurate valuation ensures that both parties in the transaction have a fair understanding of the business's worth. It also helps with investment decisions. Investors rely on valuation to assess the potential return on their investment and to make informed choices about where to allocate their capital. Section 9. Risk management. Protecting your investments. Investing always involves some level of risk. Risk management is about identifying, assessing, and mitigating potential threats to your financial well-being. One important risk management strategy is diversification. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you can reduce the impact of any one investment losing value. It's also important to understand the risk-return trade-off. Higher potential returns usually come with higher risk. Modern portfolio theory, or MPT, provides a framework for constructing an optimal portfolio based on your risk tolerance and investment goals. Section 10. Conclusion. Mastering Corporate Finance for Success. Congratulations! You've just completed a crash course in corporate finance. You've learned about capital budgeting, cost of capital, valuation methods, and risk management. Understanding these concepts can help you make smarter financial decisions. These decisions can lead to greater financial success, both personally and professionally. Remember, knowledge is power. Keep learning and growing your financial literacy. Your future self will thank you for it.